Welcome to the World Economy Podcast, where we unravel the mysteries of economic turbulence and how it impacts your financial life. Today, we're diving deep into something called global flight to safety, GFS shocks. These shocks are like thunderclaps in the economic world, and understanding them can be crucial for safeguarding your money. So, what exactly are GFS shocks? Picture this: you're enjoying a sunny day, and suddenly, dark clouds start rolling in. You can feel the temperature drop, and the wind picks up speed. In the world of finance, GFS shocks are those dark clouds. They're events or situations that make investors nervous about the state of the global economy. And when investors get nervous, they look for shelter. In this case, the shelter is found in safer investments like US Treasury bonds, gold, or stable currencies. Let's explore a few historical examples to really grasp what GFS shocks are and how they can rock the financial world. The 2008 financial crisis. This is one of the most unforgettable GFS shocks in recent history. Think of it as the arrival of a massive hurricane in the financial world. When Lehman Brothers collapsed, panic spread like wildfire. Investors, fearing for their assets, rushed to get out of risky investments and sought refuge in US Treasury bonds. This sudden flight to safety led to a surge in Treasury bond prices and a drop in yields. The Brexit vote in 2016, when the United Kingdom voted to leave the European Union, it was like a bolt of lightning striking financial markets. Investors were uncertain about the consequences, and they turned to safer assets. This pushed up the value of the US dollar and caused ripples in global financial markets. The COVID-19 pandemic. In early 2020, the coronavirus pandemic hit, and it felt like a sudden downpour on the global economy. Investors worried about the economic fallout and sought refuge in US dollars and gold. This, once again, created a flight to safety situation. But what's the fallout when these GFS shocks happen? Well, think of it this way: imagine everyone in your town decides to take cover during a severe thunderstorm. That sudden rush to shelter can lead to overcrowding and increased demand for resources. In financial markets, when everyone rushes towards safe assets, it can cause prices for those assets to surge. For instance, during the 2008 crisis, the prices of US Treasury bonds soared as investors sought safety, and yields plummeted. This, in turn, affected interest rates for everything from mortgages to savings accounts. Now, let's talk about how GFS shocks impact everyday people like you and me. When these shocks occur, they can influence the rates we pay on our loans and mortgages. They can also affect our investment returns and even the prices of goods we buy. Imagine trying to secure a loan for your dream home, and suddenly, the interest rates spike because investors are flocking to safer assets. That's the kind of ripple effect GFS shocks can have. In conclusion, understanding GFS shocks is like keeping an eye on the weather forecast. Knowing when a financial storm might be approaching can help you make smarter financial decisions. So, the next time you hear about investors rushing toward safe havens like US Treasury bonds, remember that it's a sign of a GFS shock, and it might just impact your financial world. Thank you for tuning into the World Economy Podcast. Stay with us for more episodes on navigating the turbulent seas of finance and economics.